This video covers monetary policy and stabilizing the economy. So we're going to look at conventional tools used by the Fed, which are the discount rate for banks that have some liquidity issues. We'll look at reserve requirements. Then we'll move on to inflation targeting versus price level targeting, which is an interesting concept. We'll look at the Taylor rule, which is quite insightful. And then we're going to look at unconventional tools. And unconventional tools are forward guidance, quantitative easing, and the Fed's balance sheet. So literally, the Fed can use its balance sheet, so to speak, as a tool in conjunction with this quantitative easing concept, which we'll talk about. And then we'll talk about targeted asset purchases, where the Fed goes and buys specific types of assets to alleviate liquidity problems in the markets. An example of that would be the Fed buying mortgage-backed securities many years back to alleviate the mortgage crisis. In the end, we'll look at exit strategy or the lack thereof of an exit strategy. What that means is, okay, when we go into an economic downturn like the Great Recession, and the Fed implements all these policy tools, it lowers rates, it does quantitative easing, expands its balance sheet. How does it contract its balance sheet? How does it reel these tools in? How does it raise interest rates? And when does it do that? Well, the Fed doesn't have a good strategy for that. It's had a very difficult time doing it. So what I'm saying is the Fed had 10 years to bring us back to normal, and it couldn't do it. And then the pandemic hit, and the Fed increased its balance sheet another $4 trillion approximately. Reserves shot up, and interest rates are back down to the zero lower bound. And so we're even further from normal from where we were in the Great Recession. So we got two financial disasters compounded on top of each other. And while things seem to be going really well, the Fed's, like I said, it's got a giant balance sheet. How is it going to pare down that balance sheet? And that's an important question because the Fed is the biggest player in the financial markets, at least in the bond market. I mean, they've taken over private market acquisition of bonds and mortgage-backed securities because the Fed holds it. Usually it's market participants, financial institutions, mutual funds, for example, insurance companies, individuals buy those assets. But in this case, the Fed has bought it all, or at least trillions of dollars worth. And when is that ever going to come back down? So the point is the Fed is really controlling the markets from that perspective. And what I'm hoping to see is eventually things come back to normal. Let the private markets decide what to buy. Otherwise, we end up with a moral hazard in the fact that any financial institutions can issue mortgage-backed securities. They can issue all sorts of securities. We'll just rely on the Fed buying it up and not the private market. But in terms of getting the balance sheet back to normal, when I say normal, I mean pre-Great Recession levels. But it turns out it's not as simple as you think. With trillions of dollars of securities on the Fed's balance sheet, the Fed can't simply go into the markets and sell its securities to the market to try to unravel things. It's just too big. So they have to use other tools. So getting back to the introduction here, I covered the exit strategy a bit longer than I thought, but I still have some words at the end to discuss the exit strategy. Now, let's discuss the discount window and the various interest rates associated with the discount window. So, what is the discount window? Well, let's look at it from a bank's perspective. Normally, when a bank is relatively sound and it has a liquidity problem or just liquidity needs, it'll go through the Fed funds market and it'll borrow on an unsecured basis through the Fed funds market. And usually, it's other banks that are lending those reserves. So it's a reserve market. The Fed funds market is a reserve market. And so you got some banks with excess reserves and they're willing to lend it so they get some interest income. And there's some banks that don't meet the reserve requirements for a certain period and they demand and borrow from the Fed funds market. Well, that's normally how banks get their liquidity in the very, very short run because those things, the Fed funds market is usually overnight. Now, what happens if a bank's running into financial problems, has liquidity issues? Well, then Other banks are probably not going to lend to it because it's seen as being risky, and these are unsecured loans through the Fed funds market. So the bank is not likely to be able to get funds through the Fed funds market unless it pays a really high interest rate. Hence, the Fed comes in and is the lender of the last resort. So if you have a bank that has a financial or liquidity problem, can't borrow money from the Fed funds market, it requests a loan from the discount window of the Federal Reserve. And the Federal Reserve has various criteria for evaluating borrowers. And so here we have the current interest rates associated with the discount window at the Federal Reserve. There's primary credit. Those are banks that have collateral and are reasonably sound. They just are in a pinch at the moment. And so that interest rate today is 0.25%. Now, there are some banks that are in dire financial situation, can't get money from the Fed funds market. The Fed looks at them and says, you're not really sound, so primary credit is for sound banks. And if they're not sound, they'll still get money from the Fed. And the Fed still wants to keep them afloat if they have a possibility of surviving. And what the Fed will do is they'll give them what's called secondary credit because they're not financially sound. And the interest rate associated with that is today 0.75%. It's usually, the secondary credit is usually set about 50 basis points above primary credit interest rate. So secondary credit is above the primary credit rate by 50 basis points. And you can look at that as being a risk premium associated with the lending by the Fed to risky banks. So the risk premium would be 50 basis points. But it's a little deeper than that. And here's the story. By charging a higher interest rate, the Fed is extracting a signal from borrowers. And what I mean by that is, if a bank is willing to pay 0.75% interest on secondary credit, it indicates that that bank is stressed. It can't get credit elsewhere at a lower interest rate, so it's willing to pay the 0.75%. That signals to the Fed that this bank has a problem, even without doing any research on it. Just the fact that the bank approached the discount window and wants to borrow at a very high rate is a signal in and of itself. Now, approaching the Fed's discount window is usually difficult for a lot of banks. They don't want to do it because there's a stigma associated with it. If a bank does borrow from the discount window, especially during a financial crisis, it won't be long before other banks realize that there's a bank with a financial problem and it's borrowing from the Fed. As soon as other banks hear about that, they're not going to lend in any way, shape, or form to the other bank. They're going to try to alienate themselves as much as possible. So banks only come to the discount window if they're absolutely desperate and they can't borrow the money through the Fed funds market. Don't underestimate the stigma attached to coming up to the discount window and borrowing from the Fed. It can be reinforcing. In fact, during the Great Recession, there were a number of very large banks with liquidity problems that were fearful of approaching the discount window because once it came out that they approached the discount window, that's a signal that they're sort of weak. And that signal will be broadcast across the financial system and would be self-reinforcing. So it would ultimately cause the bank to collapse. So what Bernanke did, the Fed chair at the time, he was well aware of this. So what he did was he lent billions and billions of dollars to the discount window. And lent may not be the right word. He literally gave the banks a loan. Just gave them a loan, all of them, the top 10 banks. And the reason for doing that was the Fed didn't want to give loans to particular individual banks because of the signal it provided to the rest of the financial community. So by giving all top banks a fixed amount of money, it alleviated that problem of signaling that specific banks were having a problem. He just forced upon the banks loans, regardless of whether they needed it or not. And it kind of stopped the signaling problems that you have associated with the discount window. So it was an interesting solution to a problem. Now, a couple more things here I want to cover with the discount window is that there's also seasonal credit, and that's a low interest rate because it's not deemed to be a risky loan. Banks in the farming area and in heavy tourist areas often need seasonal credit just to meet their liquidity needs on a very short-term basis. And so that's what seasonal credit's all about. One more thing before we finish up the discount window, and it's this. So what you may not realize is that the discount window is in New York, and there's only one window, but each of the regional banks of the Fed sets its interest rates. So it sets primary credit rates, as you can see, the secondary rate, and here's the effective dates. And so when coronavirus hit, these rates were dropped to the numbers you see here. Now, they're all uniform, and that's usually the way it works, but each one sets its own interest rate. The rates are all equal because the banks have coordinated amongst themselves, but it doesn't have to be that way. So keep in mind that the interest rates for the discount window is set by each of the Fed's regional banks. And there's only one discount window, New York. That's where the money flows. Now let's take a look at reserve requirements a little more carefully. Let's look, for example, at China's reserve requirement ratio over the past 35 years. And in doing so, I can compare and contrast it to the U.S. And take a look here. You have reserve requirements changing quite a bit here. Starting out at 10%, they raised it to 12, brought it down, brought it all the way up just, about the same time we brought the Fed funds rate up here. They brought it down, brought it up all the way up to over 20%, come down, and now it's around, according to this, it's around 10%. That is in stark contrast to what the United States' reserve requirement would look like. The reserve requirement over the past 35 years would be relatively flat at approximately the 10% rate that we've been talking about, excluding the very recent events of the coronavirus. And there's a reason for that reserve requirement stability. Changing the reserve requirement rate is a pretty blunt instrument. It would have a huge effect. A small change in percent would have a huge effect on the amount of reserves that banks would be required to hold. And so interest rates could gyrate significantly in response to a change in reserve requirements, at least in this country. I don't know how the underlying mechanics of how China resolves that issue of interest rates gyrating back and forth when they change reserve requirements, because notice they've changed reserve requirements to over 20%. That's double at points in time the U.S. has, and at points in time they've been pushing close to 5, which is nearly half. I don't know the underlying mechanics of how they stabilize their interest rates, but in this country, the Fed would adjust the little RD, the reserve requirement, and then use open market operations as a way to fine-tune and bring the interest rate for the Fed funds rate within its target, to manage it within its target. That said, the Fed, like I said, does not really change reserve requirements. We had a bad experience with it in this country. So as you know, we had a Great Depression. We had bank runs. The FDIC comes about in 1933. And probably by about 1935, things were looking better. And then somewhere in the mid-30s, in mid-1930s, banks were still holding on to tons of excess reserves. And it worried the Fed. The Fed was worried that, all those excess reserves out there, if banks actually lend that out, that could spark super, high inflation, hyperinflation. So what the Fed did was, we'll prevent the banks from lending those excess reserves. We'll prevent that by raising the reserve requirement. So they nearly tripled the reserve requirement at the time. But the funny thing is, banks still wanted to hold excess reserves. So the reserve requirement went up significantly, and then banks accumulated even more excess reserves, and to do that, they had to stifle loans. They stopped making loans to hoard the reserves, and the Great Depression lingered on all the way up to World War II. So if you talk to people who lived in that time, obviously they'll tell you things were really bad in the early 1930s, but they'll tell you in a lot of cases it didn't feel much better in the late 1930s, in part because of the Fed. So in the past, I've said, sometimes the Fed itself has been the problem. But economists have learned a whole lot since the 1930s, obviously. So the mistakes the Fed makes are much fewer and far between. So now, fast forward all the way to now, which is 2021, and we're sitting with trillions of excess reserves in the banking system. What if the banks start lending? Oh, that's a question that people have been posing since the Great Recession, when the Fed expanded its balance sheet using quantitative easing 1, 2, and 3. What happens when the economy rebounds and banks start lending again? Will that cause that multiplier process to balloon out so that the money supply spikes up tremendously? We get superinflation, which we'll talk about much more in later chapters. Can that happen? Well, go back to the interest on reserve requirements story that we had, right? You can raise the interest on excess reserves, keep raising that rate, and raise that rate, and you move along the downward sloping demand curve. You raise the rates, and you at the same time reel in those excess reserves. And so then it will stop any excessive lending that would go on in the economy. We prevent possibility of hyperinflation. So there's another reason for having the excess reserve interest rate at the Fed's disposal. Now let's move on to inflation targeting. To better understand inflation targeting, I'll compare and contrast it to another related concept, price level targeting. Although the Fed and other large central banks around the world, at least since the 1970s, have been doing inflation targeting for a long time, it didn't officially announce an explicit target until about 2012. Inflation targeting rather than price level targeting is the easiest and most flexible way to go about managing inflation. The Fed simply announces what it considers to be a reasonable, long-run, sustainable inflation rate, and then monitors the inflation rate over time, which is 2% now, and has been 2% basically since the 70s. The actual inflation rate is very hard to manage for the overall economy. Over the short run, and even the intermediate run, say a year or a year and a half, as it gyrates up and down a bit. In some years, it's a little above, and some years a little bit below the target. But hopefully, the deviations from 2% net out to zero over the long run. But price level targeting is less flexible. It sets out to reach a specific price level. Let's say if the CPI right now, the Consumer Price Index, is at 100, and the Fed sets a target of 102 for next year. How's the Fed going to get the price level back on target? So the best way to explain this comparison between inflation targeting and price level targeting is to show you graphically. So here I have two graphs. One's going to depict inflation rate targeting and the other price level targeting. And I'm going to show you that inflation rate targeting is a bit more flexible than price level targeting. And I'll show you a problem associated with price level targeting that you would never suspect until you actually graphed it out and went through the process. So let's get back to this side on the left here. We have the price level on this side. And here I'm growing the price level with a 2% slope over time. And let's say that in 1 year, the inflation rate actually is negative, which means the price level drops. Price level drops down. With inflation targeting, you maintain that same 2% slope. By maintaining that same 2% slope, you follow basically the same price level you had before, just on a parallel basis, just below it. Now, compare what happens with the price level. So, price level targeting. So you have a big drop. So we have a drop in the price level, but with price level targeting, you got to catch up to the price level sooner or later. And what that means is you're going to have to raise inflation at a faster pace. So this is a 2% slope, but this slope right here, this little line here, is much steeper than 2%. And so that raises problems. How's the Fed going to, in the short run, raise the inflation rate and then slow it back down again so it's back on trend? It's much easier to do it this way and keep and maintain the same trend. And if you get a 1 year off and you miss the target in one particular year, well, you just continue the same target slope. That's the main reason why countries around the world have adopted inflation rate targeting rather than price level targeting. This part of the video will cover the Taylor equation, developed by John Taylor an economist at Stanford in the 1990s. The Taylor equation explains how the Fed sets the target Fed funds rate, specifically what variables it's looking at when setting the target rate. This is not just another equation in the course. It represents a common thread in understanding how the Fed attempts to change interest rates to manipulate the economy. In other words, the Taylor equation links many of the concepts discussed in the back end of this course. The place to start is the Fischer equation, as I have listed here. It's something you're already familiar with. Then I'll take a brief detour and describe potential GDP, and then we'll get into the actual Taylor equation. So let's look at the Fischer equation. Here we have the Fischer equation. The Fischer equation says the nominal rate equals a real rate plus the current inflation rate. You've seen this before, but there's several important points I want to note here. First of all, the nominal rate is observable. We can just pick that out of various websites or the Wall Street Journal and you'll get the nominal rate. The current inflation rate is known, and so that's observable. What's not observable for the most part is the real interest rate right here. But it's one equation, one unknown, so once you have the nominal rate and the inflation rate, you back into the real rate. Now, another important aspect of this Fischer equation is that it's usually thought of as a short-term interest rate concept, meaning that, look, probably the best way to think about it is just look at it for a 1-year horizon. Could be used for a shorter horizon and even could be used for a longer horizon, but hey, let's just stick to 1 year. It's simplest. So we could have for example, so this nominal right here is unspecified. We're not saying what interest rate. Let's just say it's a money market security. Could be like a T-bill, for example. So you have a T-bill rate that you can obviously observe in a financial website, and then you have the current inflation rate, which we can get, and then we back into this real rate. So this would be a real rate for 1 year, and this would be the inflation rate for the next year. That would be the horizon. This Fischer equation was developed by Fischer a very long time ago, long before we had the idea of potential GDP and what's called a natural real rate of interest. Let me explain. First, by describing what potential GDP is all about. Potential GDP is an unobservable estimate of what the economy can produce over the long run at full employment. Economists like to believe there's a steady, long-run real interest rate that is consistent with potential GDP. Let me show you graphically. So here I have a simplified representation of the economy. We got GDP on the y-axis and time on the x-axis. And economists like to believe that there is a long-run potential GDP, like I have here with the straight line. And how do you estimate that potential GDP? Well, it's quite complex. The Congressional Budget Office estimates it. One way to think about it is roughly take the actual economy, which has a business cycle with ups and downs, and just draw a trend line through it. And that would be a really rough estimate and conceptually a very good estimate of what potential GDP is. It represents what the economy can produce at full employment. Not above full employment, not below full employment. Everybody who wants to work is working. But you know, the real economy isn't always at full employment. We have times, like I have here at the bottom, we have recessions and we have booms and busts, booms and busts. So when we're down here, it's a short-run idea, short-run concept. We're in disequilibrium because you think of this as being long-run equilibrium, this potential GDP. And when we're away from potential, we're in the short run. So when you're in a recession, we're in the short run. We're in an economic boom above full employment and people are working overtime. That's going to be the short run. But eventually, these ups and downs iron themselves out over time. And economists like to think, well, if we're really good at managing the economy, we can get rid of these wiggles and just grow really nice and smoothly. But the economy would be so much better off. We would be, as individuals, so much better off if the economy just grew at a nice smooth rate. Easy to forecast, easy to predict. There would be less risk in the economy. Economists like to interpret that when we're moving along that potential GDP, the economy is in equilibrium. There's no tendency for the economy to move away from potential. It's in long-run equilibrium. Now, the other thing that's important to know about this potential GDP, and this is a conceptual issue, is that economists like to think that along with this potential GDP and supporting this long-run potential GDP is a natural real rate of interest. And economists think, maybe that's 1 or 2% as a natural real rate of interest that supports and is underlying potential GDP. So if we could keep that natural real rate of interest constant and steady, it would help support this nice steady upward trend in potential GDP. And one more thing before we leave this graph. Do you see this slope? This slope of this potential GDP is the growth rate of potential GDP. So keep that in mind. This slope is the growth rate of potential GDP. Now let's get back to the Taylor equation. So now that we understand the Fischer equation and we have an idea about potential GDP and the natural real rate, let's move on to the Taylor equation. And so the way to think about the Taylor equation is take the Fischer equation, apply it to a specific interest rate, like the target Fed funds rate. And what we next need to do is relabel the real rate and just call it a natural real rate. And then we're going to add two gaps. We're going to add an inflation gap and an output gap. Let me explain. The inflation gap will be the difference between current inflation and the inflation target set by the Fed. Think of the inflation target here as being about 2%. So we're looking at where is current inflation relative to 2%, and that's called the inflation gap. The output gap is where actual GDP differs from potential GDP. It's where those wiggly lines deviate from the straight line that I was showing you in the graph previously. Those wiggles, those deviations from potential GDP are called the output gap. When the growth rate of actual GDP is above potential, this output gap is positive, and that's going to lead to a higher target Fed funds rate. And the way to interpret that is the Fed is trying to cool the economy when we're above potential. So when this output gap is positive, the Fed is trying to raise interest rates to cool the economy down. When the inflation gap is positive, that means inflation is above what the Fed wants it to be, and the economy is overheating, and the Fed will increase the target Fed funds rate appropriately. Now, there's two coefficients here. You can see those two coefficients. They're each 1/2. One way to interpret that is, look, the Fed has a dual mandate to keep prices stable, inflation low, so that's half the mandate. And the other half of the mandate is that we stay at full employment. We maximize employment. And that's where we look at this output gap. If we have an output gap, we're not at full employment. We're either above it or below it. So in the long run, this inflation gap and this output gap are zero, which means these two terms just wash away. And then what we're left with is something that looks a lot like the Fischer equation. It means that the target Fed funds rate is equal to the natural real rate plus the current inflation rate. Yeah, so when we're in a long run equilibrium, these gaps disappear and the target Fed funds rate is going to equal the natural real rate and the current inflation rate. It's probably best to show you an example. So here we have an example, numerical example. Suppose the natural real rate is 2%, just suppose, and that the current inflation rate is 2%, and the Fed has set the target inflation rate at 2%. GDP growth rate, actual, is 3%, and potential growth rate is 3%. If we plug the numbers in, here's the equation, we plug the numbers in, these two gaps disappear because we're basically in equilibrium. And here you have target Fed funds rate of 4% equals the natural rate of 2% plus the current inflation rate of 2%. It matches the Fischer equation, which just boils down to 4 equals 2 plus 2. Now, what's really important and insightful and helpful later on is this concept of a Taylor rule. The Taylor rule says that the coefficient on current inflation, which is implicitly 1, plus the 1/2 on the inflation gap, must exceed 1. And the way I have it here, it's obviously greater than 1. It's 1.5. And what that means is if current inflation jumps by 2%, let's say it jumps to 4%, then the Fed must raise the target Fed funds rate by 1.5 times the 2% gain in inflation. In other words, it must increase the target Fed funds rate by 3% in order to increase the natural real rate. What we're saying here, let me go scroll down here a little bit. It says, look, current inflation now is 4%. It went up 2% to 4%. So I put the 4% here and the 4% here. And notice, when I say implicitly, right here, I'm saying implicitly, the coefficient in front of inflation, right here, is 1. So there's basically a 1 here. But nobody multiplies 1 by anything because it doesn't do anything. So there's a 1 in front of this 4 is what I'm saying. And that 1 plus this 1/2 equals 1.5. And the reason why I'm telling you that is this is the Taylor rule. And it's very important. It says that, look, if inflation goes up by 2%, the Fed has to raise the target Fed funds rate by 3% in order to cool the economy down. In other words, the Fed has to increase the target Fed funds rate by more than the increase in inflation. And it does that to increase the natural real rate. And that's key. In other words, if the Fed simply raised the target Fed funds rate by the increase in inflation, the real rate would be unchanged and the economy would never cool down. So again, the Fed has to raise the target Fed funds rate by more than the increase in inflation to increase the natural rate and cool the economy. And it works in the opposite direction. So when inflation falls, the Fed's going to decrease the real rate by decreasing the target Fed funds rate by more than the fall in inflation. Okay. So now in the scenario that I showed you, we end up back at the Fischer equation where the target rate is 7%. Notice it went up from here. We had it at 4%. Inflation rose 2%, and now it's at 7%. And the real rate is 3%, and there's inflation at 4%. So one of the reasons why I'm telling you this is not only is it really important on how the Fed should operate, but we talked about in the past about the spiral of inflation in the 1970s in this country. And now we can get a good explanation on why that occurred. In the 1970s, we got whacked with OPEC price increases in oil. We got an oil shock. And we got an oil shock. Inflation shot up and spiked up. And what the Fed did was it started to raise its Fed funds rate in response to the increased inflation. So if inflation jumped, say, 3%, the Fed increased the Fed funds rate by 3%. Well, if it increases the Fed funds rate by just 3% and equal to the change in the current inflation rate, it left real rates unchanged. It didn't cool the economy down to try to get rid of the inflation. There's the problem. We didn't realize this, the Fed didn't realize it until well after the fact, until people started to look at the Taylor equation. We realized that in order to manage the economy, when it comes to inflation, you got to change the target rate by more than the change of inflation. So now let's ask the question, what does the Taylor equation look like now that we're in the middle of the coronavirus and interest rates are at the zero lower bound? Well, the target Fed funds now, let's just call it 0. And it's going to equal the natural real rate, which is unobservable, right? And it's the current inflation. Let's just say approximately current inflation is 2%. And we have 1/2 times 2 minus 2. The inflation gap is 0, basically, so that plays no role. And then we have 1/2 times, I wonder what the GDP rate is now, the growth rate. Well, ballpark, it's minus 3.5% is the latest estimate on an annual basis. And by the way, this is always on an annual basis. Like nearly all interest rates, they're disclosed on an annual basis. And these growth rates are annualized. So here we have the gap. Look, the gap is minus 6.5% times a half. And so that's going to have a minus 3.25% effect. This is 0, this is 2. And so what that implies is the natural real rate, the unobservable natural real rate, is 1.25%. That is the interest rate that allows potential GDP to grow like it does. So underneath the assumptions of a potential GDP is a natural real interest rate. Now, let's use the Fischer equation, and we get to a subtle point. The Fischer equation says, look, the nominal rate equals a real rate plus an inflation premium, current inflation. This is 0. The inflation rate's about 2%, and that means the real rate of return is about minus 2%. So that's what market participants are earning in terms of real rates of return. If they're getting an interest rate of close to 0 in money market securities, and the inflation rate's 2%, the real rate has to be minus 2. So then you got to ask yourself, well, why would anybody want to park their money in an instrument that earns a real rate of return of minus 2, whether it be a treasury security or a Fed funds transaction? Well, that's a good question, but you got to ask yourself, well, what are the other opportunities? What are the other choices out there? You can sit on your money, right? And if you sit on your money, it's at risk. Where do you actually put so that it has no risk? There are financial managers and financial institutions that sit on billions of dollars of money market type funds. Billions. Where are they going to park that money safely? They can't park it in an individual bank because it's only insured up to $250,000 per account. So that's not going to work. What about all the rest of the money? It's all at risk. Well, they put them in the treasury securities. Treasury securities are the safest thing out there, but their treasury securities, like 3-month treasuries, many of those rates are close to 0, which means the inflation rate of 2% means they're losing 2% because there's no other choice. Where do you put your money? And that's the question. That's the problem financial planners struggle with now. If you're a financial planner and you want your clients to earn a decent interest rate with relatively low risk, you're just not going to find it. And so that's the problem where we sit right now. Savers, the ones that want to take low risk, are earning negative rates of return. Now, before I go any further, I have to explain the discrepancy between the natural real rate and the real rate in the Fischer equation. It's different. What's the difference? It's 3.25%. The reason why those two rates differ is because the economy is not in equilibrium. It's in a short run disequilibrium at the moment, which ought to make sense to you. Nobody would characterize the situation we're in with the pandemic to be a long run equilibrium. Let me show you where we are now in this video. We just finished the Taylor rule here in the middle of the slide. Now we're looking at unconventional tools. We'll talk about the target purchases of the Fed. We'll talk about forward guidance and quantitative easing and the balance sheet. Let's start off with target asset purchases. The best way to motivate it is let's go to an FOMC statement and look what it has to say. So this is January 27, 2021 statement from the Federal Open Market Committee. It says the committee is committed to using a full range of tools to support the economy in this challenging time, thereby promoting its maximum employment and price stability goals. Okay, then it gives us a general statement about COVID and the economy, very vague, and the path of where they're going and the economy depends on, obviously, the virus. Come down here, this is what we want to look at. And this is a great way to review some of the material that's in this video. So here it says the committee seeks to achieve maximum employment and inflation at the 2% rate over the longer run, with inflation running persistently below
its longer run goal, the committee will aim to achieve inflation moderately above 2% for some time, so that inflation averages 2% over time, and longer term inflation expectations remain well anchored at 2%. Now, okay, so it's telling us that they're slightly below, and they're not even using the word slightly. I'm telling you it's slightly. They're running slightly below 2%, so it's almost as though they're exaggerating the fact that they're below 2%. They're not very far below 2%. But nevertheless, they have a 2% target, and that's where they want expectations to be, and that's where they want inflation to actually be. My interpretation of those statements is that the Fed wants to remain credible, and so it wants to show people that it's serious about maintaining a 2% target rate for inflation. By the way, did you catch that forward guidance? Yeah, take a look. Right here. The committee will aim to achieve inflation moderately above 2% for some time, so that inflation averages 2% over time and longer-term inflation expectations remain well anchored at 2%. That's forward guidance. It's telling you this is what we aim to achieve. And in doing so, guides the financial markets to move in the direction of 2% inflation. And it continues right here. The committee expects to maintain an accommodative stance of monetary policy until the outcomes are achieved. Again, more guidance, more forward guidance. Continuing, the committee expects to maintain an accommodative stance of monetary policy until these outcomes are achieved. The committee decided to keep the target range for the Fed funds rate at 0 to 0.25% and expects it will be appropriate to maintain this target range until labor market conditions have reached levels consistent with the committee's assessment of maximum employment, and inflation has risen to 2% and is on target to moderately exceed 2% for some time. So it's looking for that average around 2%. Okay, targeted percent, not targeting a price level, targeting 2%. In addition, now here's where we want to focus in on this section. It says, in addition, the Federal Reserve will continue to increase its holdings of Treasury securities by at least $80 billion per month and agency mortgage-backed securities by at least $40 billion per month until substantial progress has been made toward the committee's maximum employment and price stability goals. These asset purchases help foster smooth market functioning and accommodative financial conditions, thereby supporting the flow of credit to households and businesses. Okay, so it's telling us targeting $80 billion worth of treasuries. Didn't tell us what maturities, but they're probably not just short term. They're intermediate and possibly long-term treasuries. And then it says agency mortgage-backed securities of $40 billion. Those are government-sponsored, entity-backed, or issued mortgage-backed securities. So now let's move over and on the paper and pencil, try to analyze what's going on with targeted asset purchases. Having just read the Fed press release, I want to go one step further to make sure that we understand how target asset purchases increase the flow of credit to households. That statement, as I just read it, is referring primarily to mortgage-backed securities. That's how I interpret it. So what's going on here? How does that increase the flow of credit to households? First off, we know that when the Fed purchases mortgage-backed securities and it issues reserves, this purchase is going to push up the price of mortgage-backed securities and pushes the yield or the interest rate associated with that down lower, which means housing costs are going to fall because mortgages are cheaper with lower interest rates. So ultimately, it comes back to the bank. Well, how does that work? Well, these mortgage-backed securities came from a bundler. So the bundler bought mortgages from the bank, got the mortgages on his books, and processed them and turned them into mortgage-backed securities, sold them to the Fed, who ultimately bought them and holds them. And the fact that it's buying so many billions of it is pushing the price up and the costs down. So banks initially have mortgages. They sell those mortgages to bundlers. They get new cash balances. They get cash. Think about it. Some of these mortgages can last 30 years. That means it's very illiquid for a bank. Why can't it just sell these mortgages, get cash, and then it can issue more mortgages, and the bank can collect fees in the process? So the bank gets cash, gets rid of its mortgages, The mortgages go on the bundler's books. Takes a couple months, issuing commercial paper to finance this, by the way, to finance these mortgages. The bundler processes the mortgages, and they're turned into mortgage-backed securities. And then the mortgage-backed securities are sold to the Fed. And then the bundler pays off the commercial paper with the cash it got from the mortgage-backed securities. And the whole process starts over again. So, as you can see, the Fed's purchases translates in the cash at the bank and then to households eventually. Now you might ask, well, wait a second. Aren't the banks holding trillions of excess reserves? The answer is yes. So why would you want to do this? Well, it's not just banks. It's also non-banks that issue mortgages. Non-banks don't have excess reserves. They don't have any reserves for the most part. They don't have reserves as we know it in the banking system. So this whole process means the mortgages come off the non-banks' books, the mortgage issuers, and they get cash, which ultimately ends up in the hands of households who want to get new mortgages. Now I want to tie down one more loose end with respect to target asset purchases. So the Fed sometimes purchases intermediate and long-term bonds. And that makes sense because we know that it's long-term interest rates that drive the economy. Long-term rates are very important because many companies borrow long-term to finance long-term projects. So long-term interest rates are very important. Now, that seems to contradict what I've been saying all along here, especially with open market operations. So remember, the Fed does open market operations, and under normal circumstances, it's affecting the Fed funds rate, it's buying short-term Treasury securities, and the question is, how does that affect long-term interest rates? We know those purchases add a ton of liquidity to the money markets, which is really important. So adding liquidity is really important. But then again, how does it affect long-term rates? Well, it works through the yield curve and the fact that long rates are a function of short-term rates. And here's what I mean by that. Let me just give you a timeline and give you an exaggerated example. Let's say that the interest rate for 1 year is 3%. And the interest rate here for the second year, starting from year 1 to year 2, is 7%. So 3%, 7%. If you bought a 2-year security, right, the average yield for that would be, and you can do the math, it's 1.03 times 1.07 to the 1/2 power minus 1. That equals 0.498, or about 5%. And you can eyeball it. You don't need to do the compounding of money here that's normally done when you analyze the yield curve. You can just take the average of these two. So a 2-year security earns a 5% rate of return. Now, notice what happens. And this is a bit exaggerated, but it'll work. What happens if this goes up? This 3% goes up. You know that it's going to boost this average up for 2 years. So think of this as a short-term yield, a short-term interest rate, and this is a long-term interest rate. Short-term rates go up. Even if this rate here stays flat, stays at 7%, this goes up, it's going to cause the 5% to go up the 2-year rate. Now, we could exaggerate this out further, but here's the thing. Let's say we got 30-year securities. How can 30-year interest rates on 30-year bonds, change by the Fed, with the Fed manipulating the Fed funds market, which is an overnight interest rate, or the fact that it's buying through various transactions short-term treasuries, like maturities of 6 months? Well, 6 months kind of comes out right about here. So how can the Fed changing interest rates right here? In fact, right here, it's so small with overnight interest rates with Fed funds. How does that affect this average all from here all the way to here? That's a good question. Because think about it. I gave this equal weights, because this was 1 year, this was 1 year, and so each got an equal weight when I calculated this average. This 30-year yield needs to have a weight here, which is really, really small. And the weights, by the way, have to add up to 1. And this weight is almost 1 because it takes up almost the entire horizon. So again, how can the Fed buying very short-term assets affect interest rates going way out here for 30 years? Well, it does work this way, but the Fed, through signaling and telling the markets and jawboning, telling the markets it's going to raise interest rates, then people in the market get to really, recognize that the Fed means business and it's credible and that it's going to raise interest rates. And it'll raise interest rates. And when the Fed raises interest rates, it just doesn't do a one-off increase. You never see a one-off increase and then it goes like this. Look at the Fed funds rate over time, and you see it looks like this. Or it comes down like this. It's rarely a one-off thing. So the fact that the Fed is going to notch interest rates, and it telegraphs, gives forward guidance that it's going to raise rates or drop rates, means it's not just affecting the short-term markets, it's going to affect even the long-term markets. Not maybe not one for one, but it's going to have an impact on long-term interest rates. Because the Fed is setting monetary policy through forward guidance, telling the markets where it wants to go. And then it can occasionally use target asset purchases to buy, maybe 20-year treasuries, and it buys 20-year treasuries, it pushes their price up and their yield down. And that's how the Fed affects long-term markets. Now what I'd like to do is piggyback off the target purchases discussion we just had and look at quantitative easing. The best way to portray quantitative easing is to show you a graph. Here's the Federal Reserve's assets since 2004. So you see their assets pretty well flat, about $1 trillion. And then during the Great Recession, 2008, jump. And then we got another jump. And we got another jump. Ignore this for the moment. I just want to focus on these 3 jumps that we see here. This first jump happened in November of 2008. That's when the Fed announced it was going to purchase $600 billion in mortgage-backed securities. And why would it do that? Well, to increase liquidity to households eventually. That purchase was labeled QE1. It wasn't actually labeled until after the fact because the Fed, when it implemented quantitative easing 1, 2, and 3, it didn't realize and didn't recognize that it was going to have multiple quantitative easings. So this was just a quantitative easing, later called QE1, that purchased $600 billion in mortgage-backed securities to increase liquidity eventually to households and the real estate market. So look at that big bump up, $1 trillion in assets. Then in November of 2010, the Fed announced it was purchasing $600 billion in Treasury securities. Again, to help out the markets, add liquidity, and keep interest rates low. And there we have it, jump up of, just there it is, about 600 billion, not quite $1 trillion jump. And we're flattened out for a while. And then in September 2012, the Fed announced it was going to purchase $40 billion per month of treasuries and do open-ended purchases of mortgage-backed securities. So after a couple of rounds of quantitative easing, the Fed realized instead of doing just one-time shots, why don't we just put ourselves on a program, a monthly program, to buy assets. And as a result, look at that, all those notches going up. We went from about $3 trillion to, $4.5 trillion in assets. And then, the economy was doing fairly well, right here, doing quite well. And the Fed was trying to unload those securities. A lot of them were maturing, and it may have sold some. And it was declining, which was a good sign. We were getting back to normal, at least moving in the right direction. Then look what happened in September of 2019. The money markets went a little wild. And what do you know? The Fed had to come to the rescue and do some purchases. So this is pre-coronavirus right here. And the Fed's buying assets. I'll show you a picture of why that happened in a second. And then you can see the asset purchases that the Fed is doing for the coronavirus impact. So let's take a look at why we have this blip in assets on the Fed's balance sheet. So here we have the Fed funds rate, the effective Fed funds rate right here, which means it's the actual Fed funds rate. We have the Fed funds target in gray, and then we have SOFR, which is the secured overnight financing rate. These are all interbank lending. So this is the Fed funds rate, and then we have secured. So Fed funds is unsecured lending. SOFR means secured overnight financing rate. It's secured by collateral, kind of like repos, but no agreement to repurchase. We're starting out in 2016. Interest rates were near at the zero lower bound. And what happened? The Fed started notching up interest rates, like I said not too long ago. It rarely does it in a one-off deal. It often does multiple increases or decreases. And then here, look, here's September of 2019. Look at this big blip. The money markets were in a bit of turmoil. And according to the Fed, it was just a series of routine events that all happened at once that caused this money market spike. So this is the basis points. And you can see that rates jumped out of their target range from around 2% here, target range, to over 5%. And the Fed accounted for that by saying, look, you know, the Treasury didn't get enough tax revenue in, so it had to issue Treasury securities, so that flooded the market with Treasury securities. The primary dealers couldn't handle it all. And so the Fed ended up having to purchase securities to help out the financial markets to keep interest rates from spiking and put rates back into target range here. That's why we saw that increase in 2019 of the Fed's assets. The Fed had to buy securities to tamp down interest rates. Basically, there was a liquidity squeeze going on. So in my mind, it was a bit disappointing to see the Fed moving into the markets at a time when we were not only at full employment, possibly above full employment. In other words, we had really low unemployment and the economy was moving along really well. And there we have it, the Fed coming in and doing some easing in the midst of an economic boom. Okay, moving right along, I just finished up unconventional tools. I talked about forward guidance by looking at that FOMC statement. Now what we want to do is look carefully at exit strategies. What kind of exit strategy does the Fed have when it comes to quantitative easing and unwinding all that it's done to try to stimulate the economy? I've been watching the Fed for over 10 years since the Great Recession. And boy, it's hard to find an exit strategy. It's hard to see what it's been doing to exit all that it's done to try to stimulate the economy since the Great Recession. Hence my question marks.
How do I know that? Well, rewind, go back to the quantitative easings and all the assets it purchased in 2008 and 9, and look at the balance sheet, and you'll see that a lot of those securities are still there. The Fed's balance sheet's $4 trillion. It hasn't been reduced. We've had relatively good economic times for nearly 10 years with some ups and downs. But by now, 10 years later, we should have been off that. The Fed should have unloaded those assets. Some of them plain out matured, and some of them matured and they rolled them over. In other words, when they matured, they purchased more. But there really wasn't much of an exit strategy. When the Fed tried to implement an exit strategy, the bond market reacted very negatively to it. And so what do you have as a result? A balance sheet that's $4 trillion and hasn't shrunk back down to about $1 trillion where it ought to be. So that's my take on exit strategies.
It's interesting to note that those statements I just made on the Great Recession and all the quantitative easing and the failure of the Fed to taper and the failure of the Fed to have an exit strategy, that was all taped in March of 2020, right when the coronavirus hit. Now look at where we are. still in the middle of the pandemic. The Fed's balance sheet is now at $7 trillion. It went up $3 trillion. It went up $3 trillion in less than a year. And interest rates are now at the zero lower bound again. And so we're flat out near zero. Reserves have shot up, so the money supply has jumped. And we're kind of right back where we were again. In fact, even further along, meaning given that the Fed did not clean up the balance sheet 10 years after the Great Recession, we're now compounding and piling on trillions of dollars more onto the Fed's balance sheet. And the problem is, if the Fed couldn't reduce its balance sheet from the Great Recession after 10 years, now what's it going to do after you take all the asset purchases from the Great Recession and pile on top of that the coronavirus purchases of securities? The Fed's balance sheet, like I said, is $7 trillion. When is all that going to unwind and shrink? Because eventually we're going to come to another recession or another financial crisis. Hopefully not for another 10 years, but given the Fed's history with the Great Recession, it doesn't look good that things are going to be cleaned up in 10 years from now. Oh, and by the way, the Fed doesn't seem too worried about it, although economists in the private sector are concerned. And their main concern is that eventually all those assets on the Fed's balance sheet and the corresponding reserves on the right-hand side of the balance sheet are going to lead to inflation, eventually, unless the Fed can unwind things quickly. But then again, they weren't too fast after the Great Recession. So the Fed's hands are tied, but they're not completely tied. The Fed has really good interest rate management tools. As I mentioned in another video, that the Fed has interest on excess reserves, that it can literally move up and down on decree, just come out at the end of an FOMC meeting and declare a higher interest on excess reserves. So the Fed has the ability to raise interest rates off the floor, off the zero lower bound, to get us back to a normal level of interest rates with a positive real interest rate. That would be very important. And to cool the economy if necessary, well after the coronavirus is gone. Let me update this video and give you some more information. Much of this video was produced in 2020 with a little bit of updating in 2021. And as you can tell from the press release that came out from the FOMC in 2021, wow, there's hardly any inflation back then in 2021. Now it's 2022, to be specific, it's June of 2022, and inflation, as best we can gauge it, is hovering over 8%. Some statistics say 10%, but in any case, it's fairly high. So, as you can see, a year ago, the Fed didn't even realize what was on the horizon in terms of higher inflation, and now we're dealing with it. And so now we're in a tight situation. How is the Fed going to stifle out inflation and keep the economy moving? Not a simple task. At this point, what it's doing, and it just did it today at 2 o'clock, it announced a 75 basis point increase in interest rates. And so what you're going to see is interest on excess reserves, or reserve balances, are going to go up. And so that's how interest rates are going to go up. Interest rates are not going to go up because the Fed's going to be conducting open market operations and selling securities. Remember, the supply of reserves is so huge, the Fed simply can't conduct open market operations to try to sell all of those treasury securities that it has on its balance sheet. So now it's using interest on excess reserves, which I'll cover more in another video on conventional and unconventional monetary policy tools. So normally, the Fed is really good at predicting inflation, normally. But this time it's different. It's different because the coronavirus and the supply shortages that it caused, the bottlenecks in the economy, all of that threw a wrench in the analysis. The Fed doesn't have any background. There's no history of such supply shortages and shocks. We've never really been hit by a virus, at least not since 1918, and we really didn't have any economic data back then or much of a Federal Reserve at that point to be able to do anything. So this is new to the Fed. The Fed really didn't know how it was all going to unwind. I don't think anybody did. So the Fed is backed into a corner at this point, So it's really hard to tell what's going to happen in the future. But what I'm concerned about relates back to that Taylor rule I was talking about. Now, inflation went in the past year from about 2% to, let's say, 8%. That's 600 basis point increase. And you might ask yourself, well, if that Taylor equation is right, and we multiply 6, the change in interest, the change in inflation, that 6%, times 1.5, that's 9%. What that means is the Fed should be jacking up interest rates by 9%. So they were close to zero in 2021. And the question is, are they close to 9%? And the answer is no, it's nowhere near 9%, even though the Fed has increased rates a number of times in the past year. So it's behind the curve, so to speak. That's the worrying part. So if it stays behind the curve and real interest rates are going to decline, that's not going to slow the economy in order to reduce the inflation. That's the concern.